what is the optimal capital structure. And we found out that the cost of capital for a company, for entire company, which in other words we call it WACC, weighted average cost of capital, declines, okay, as the debt equity ratio increases, right? So what that means is the company value will be maximized when the company actually has 100% debt and no equity, right? The more debt the company takes on, it increases, it lowers the cost of capital, and then it increases the value of the company, right? So the conclusion would be 100% debt and no equity would be the ideal, right, or optimal capital structure, right? Well, but in reality, that doesn't happen. You can't really find the companies with 100% debt and no equity, right? So we're trying to, in today's class, the rest of the chapter 13 is devoted to explaining why, right? Why we don't see the 100% debt situation. Okay? So if you don't have any question, we can go on with today's topic. Okay. All right. So, according to our textbook, we have two reasons why this 100% debt situation doesn't really happen in reality. Okay? Because there is a financial distress cost. Okay? When the company takes on more and more debt, the risk increases, okay? And risk of financial default, financial trouble increases, right? Because the debt servicing cost increases, right? So when the company's sales slows down and their sales revenue slows down, then there may be a situation that they can't even handle their debt servicing costs, debt payments, right? In that case, they may have to declare bankruptcy, right? There are direct and indirect costs of bankruptcy, right? Direct costs of bankruptcy include the legal cost, restructuring cost. Okay? So, the companies declare bankruptcy in order to protect themselves from creditors. Okay? So they get the protection for a certain period, okay? And they reorganize or restructure, okay? Get rid of unprofitable business, okay? And improve the profitability of the company, and so on, right? So, but in order to liquidate unprofitable section or sector of their business, they may have to get rid of it at fire sale price. In other words, you're not going to get really good price of any equipment or buildings you try to sell in this situation, right? So you're going to lose a lot of money, right? Also, the legal cost will be quite severe, right? The lawyers will charge an arm and a leg, right? So that's what we call direct cost of bankruptcy. Okay? Indirect cost may include the loss of customers, suppliers, and employees. Okay? So when a company gets into a bankruptcy situation, right, restructuring situation, Of course, whether the company will get out of the bankruptcy eventually, that is even uncertain, right? So, first of all, you will lose a lot of customers, right? And also suppliers. Suppliers are as important as customers, right? You need really stable suppliers who supply all the materials and components to you for your business, right? But, when a company gets into bankruptcy, the suppliers think, well, when we supply our products to this company, there is a chance that we may not get paid, right? So, some of the suppliers may not be willing to supply anymore, right? And also employees. Some employees may look for another job, okay? And you may have to actually let go of a lot of employees to save costs. Okay? In any company, the payroll is the largest or the biggest proportion in the total cost, out of the total cost. Yeah? Payroll is the largest component. Okay? So many times when a company gets into financial trouble, okay, they tend to slash a lot of employees or position. Okay? And when they finally get out of the bankruptcy, they may have to hire new employees. Okay? But hiring new employees is quite expensive because you have to give on-the-job training again. Okay? On-the-job training is doubly expensive because the new employees are not as productive as existing employees. Okay? And then existing employees also have to spend time giving training to new employees. Okay? So even the existing employees lose productivity. Okay? So that's the cost to a company. Okay? All right, so that's the financial distress cost. So the story is, in order to avoid this kind of situation, the companies will be reluctant to take on too much debt, right? I mean, if you think about just the capital structure, right, mathematically, then it's the more debt you take on, right, the company value is supposed to increase, okay? But then there is this financial distress cost, okay? So you don't want to get into that risky situation. Yeah? Agency cost. The beginning of last semester, we talked about agency problem. Okay? Can anybody describe what the agency problem is? Yeah?
This is a different relation between stockholder interest and management interest.
Okay, right. So we're talking about two different parties, principal versus agents. Right? There are principals and there are agents. Okay? For example, in the situation of stockholders, stock owners, shareholders. Okay? Shareholders can be considered principals, right? Because they are the owners of the company, right? Then who are the agents? Agents are the people who are supposed to look after the interest of the principals, right? In other words, they are supposed to represent and work for the principals. Okay? So if shareholders are principals, then who are agents? Yeah? Intermediaries? What do you mean by intermediary? Are you talking about financial intermediaries or?
So the
companies between?
Between the shareholders and the company.
Okay. If the shareholders are the owners, right? they want to get their desires to increase the profit, right? Who are supposed to work to increase the profit? Managers, right? CEO or whatever, managers. Okay? So you can say shareholders are principals and managers are agents. Okay? So agents are supposed to work for shareholders. They're supposed to realize the interest of shareholders. But then, what's the agent problem? What do we mean by agency problem?
They have to maximize the profit in short period of time.
Who says that? Are you saying shareholders want that or managers want that? Managers want to maximize the profit in short period of time. Is that bad? Why? Why is it bad?
Because they want to be hired forever.
You mean they want to retain their jobs, right? They don't want to be fired. Okay. Yeah, that's, I guess, one of the examples, right? So the reason is, the manager, theoretically, what shareholders want is shareholder wealth maximization, right? That should be the ultimate goal of a company, right? And managers are supposed to maximize shareholders' wealth, right? But they may have their own goal, right? Because in order to maximize the shareholders' wealth, what that means is they have to do everything possible, they take on all the profitable projects, right? So they may have A, B, C, D, E, F. Let's say we have 6 potential projects, okay? And you calculate the net present value for all these projects, right? And it comes out to be, pretty large, positive, 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 negative, negative, right? Then, in order to maximize really shareholders' wealth, you have to draw the line here, right? And you're supposed to take on all 4 projects with positive expected or positive net present value, right? But in reality, managers may take on only 2 and forget about C and D, right? Because? Why would they do that? Too risky, right? Well, when you calculate net present value, you're supposed to consider the risk of all the projects, right? And considering the risk, you can calculate the expected monetary payoff, expected monetary value, right? I think we talked about it. You multiply the payoff times the probability of success, right? So when you calculate NPV, you were supposed to have done all that analysis, right? So considering all the risk, right? A, B, C, D comes out with positive NPV, right? Then you're supposed to, right? If you really want to maximize shareholders' wealth, right? You're supposed to take on all, 4 projects. But in reality, managers do not do that because even with a little bit of risk, right? If there is a risk of failure, let's say this project D has 90% chance of success, 10% chance of failure. Okay? Then the thing is, when you calculate all these probabilities into the EMV and reflect it in net present value, right? If it comes out to be positive, you have to take it, right? But the managers think, well, no matter how small the chance is, there is a chance of failure, right? And what happens if I fail, if this project fails? If it succeeds, then of course, it increases the value of the company, and it can make the shareholders happy, and I may even get promotion, right? But if it fails, I may lose my job, right? So that's the idea of conflicting goals, right? The shareholders want shareholder wealth maximization, right? Managers, their actual goal is preserving their job rather than maximizing the shareholders' wealth, right? So that's the nature of agency problem, right? The two parties have conflicting or inconsistent goals, right? Then we may have a problem, right? So here, well, what are we talking about? The shareholders attempt to maximize return by taking on more debt will eventually prompt protective restrictions from investors. So here, when we say investors here, apparently we are talking about debt holders or bond investors, bond holders, right? So here, instead of shareholders, we have bond holders or creditors, right? Creditors as principal, right? And who are the agents in this case? Who are the agents? It's right there. Stockholders, shareholders are agents in this case. Why? Because they have borrowed money from bondholders, right? So they are supposed to look after the investor's interest, right? When they borrowed money, they made a promise, right? They promised that after a certain period, right, they're going to pay back the money back, right, with interest. Well, actually, they make the interest payments every period, right? So that's what the bondholders want. They want their money back safely, right, with interest return, right? Shareholders, unfortunately, their goal is wealth maximization, right? Shareholders' wealth maximization, right? So in this case, the story is they may take on some risky project in order to, the first principle in finance is the higher the return, the higher the risk, right? If you want higher return, you have to take higher risk, right? So the shareholders may, try to use money for risky projects. Yeah? So it's called the asset substitution. Right? Asset substitution. Asset substitution means the shareholders or the company raise capital saying that we're going to invest in some low-risk projects, right? But once the capital is raised, in other words, once the money is borrowed, they use it for riskier or high-risk project, right? That's the idea of asset substitution. Okay? So that's one case of agency problem. Okay? So eventually, when the company borrows more and more, and when the company invests money or uses money in riskier project, they're going to face some limitation, or what they call the protective covenants, okay, from these investors, the bondholders. Okay? They try to protect their money, right, from risky project. Right? So increasingly, they're going to require some conditions, okay? Conditions to be enforced when they lend their money. Okay? Okay, let me write it down here. Protective covenants. Okay, protective covenants and monitoring. Okay. Protective covenants means when they invest their money into the company. In other words, when they purchase the bond, okay, they require a lot of conditions. They list all kinds of conditions, right? The company cannot take on more than certain amount of debt, right? So debt equity ratio or debt asset ratio has to be maintained below certain rate, right? And then they also require the kind of projects that the company can take on, right? And there may be some other many limits on type and amount of new debt that a company can acquire, right? So, they will be very restrictive, okay? And also, they may increase monitoring, okay? In other words, they want to know everything about what the managers do, right? So they require frequent reports, right, from the managers, right? And that will be quite expensive. That will be quite, it harms the operating efficiency, right? Increased monitoring harms operating efficiency. Okay. All right. So this is the case of agency costs, right? So we have these reasons. For these reasons, the companies will be reluctant to go or take on too much debt, right? So that's why we don't see the 100% or even 90% very high debt percentage in the capital structure. Okay? All right, so considering all these factors, right? If you look at this equation here, market value of levered firm is market value of unlevered firm plus present value of tax shield. This is what we talked about in the previous class, right? Here. This horizontal line is the market value of unlevered firm because the company doesn't have any debt, right? The debt equity ratio doesn't change any company value, right? But when there is an income tax, right? When there is income tax, the higher the debt equity ratio will increase the value of levered firm. Market value of levered firm increases in a straight linear fashion. Okay? The difference between the two is the present value of tax shield. Okay? That's the present value or discounted value of tax saving, basically, coming from income tax. Right? Okay. All right. So we talked about those two components. However, we have to subtract the present value of financial distress cost and also the present value of agency cost. Right? Well, unfortunately, I don't think anybody has the exact formula, mathematical equation to calculate the present value of financial distress cost or agency cost. Okay? But we just discussed that there is, or there are, these costs. You cannot deny that there is a risk, right, of financial distress when you take on too much debt, right? So definitely there are these costs. Yeah? So we have to think about how to bring in these considerations when we analyze and assess the market value of levered firm, right? One thing we can understand here, or one thing we observe, is when the cost of it rises, the cost of capital, in other words, that's investors' required return, rises as the proportion of debt increases, right? Because investors consider it more and more risky, right? The rise accelerates when the capital market considers the new debt excessive. Okay? What does that mean? Here. Okay? So this is exactly the same graph, same chart as we've seen just now here, this one, right? Originally we have unlevered firm here, levered firm in the presence of corporate income tax, right? But there is a certain level of debt equity ratio here, or certain level of debt, right? So up to that level, the value of the levered firm rises just as before, right? And when we approach this kind of threshold limit, right? When the investors consider this is a little bit too much, this is a little bit too much debt, right? So when the company's debt equity ratio approaches that level, then with the actual market value of levered firm starts deviating from this green straight line, right? And then as the debt equity ratio increases, right, that accelerates. So this difference here, that's the present value of financial distress and agency costs. Again, we don't have actual formula or equation for assessing these values, right? But we can imagine, based on the concepts, right? So up to certain level, it's okay. I mean, the investors are not really concerned about the level of debt. But when the level of debt approaches certain limit, right, then this the present value of financial distress and agency costs start materializing, right? In other words, it starts inserting the wedge between the green line and this actual value, right? And that accelerates as the amount of debt increases from that level. Okay? So actual market value of levered firm will follow this path, right? The brown, whatever, maroon color path. Okay? Okay, so here's another chart. All right. This is, you can compare this chart to this chart. Okay? This was the case without income tax. Right? Without income tax, we have the cost of capital. This is KI. What was KI? Just look at it here and tell me what it is. KI is after-tax cost of debt, right? And after-tax cost of debt, if there is no tax, right, then it just remains the same, right? It's not affected by the debt equity ratio, right? Cost of equity rises because when the company takes on more and more debt, right, investors consider it, or the equity investor we're talking about, right? Equity holders consider it riskier, right? So they will require higher and higher rate of return, right? So as a result, we come up with this weighted average cost of capital, right? This line declining, right? But when we consider, because if the KA, weighted average cost of capital, declines in this monotonic fashion, straight linear fashion, then of course the more the better, right? The more debt you take on, the average cost will be the lower, right? But when we consider the distress cost and agency cost, we can change that picture this way, right? So with the taxes, income tax, and the distress cost, right? We can understand it this way. This blue line, of course, is KI, right? It used to be straight line, right? But why does it increases slowly increases, and then after a certain point it starts accelerating? What's the story here? Okay, so that's the cost of debt here, right? That blue line is cost of debt, right? And if you don't consider financial distress cost or agency cost, right? It's supposed to remain flat, right? Horizontal, right? But when you consider the financial distress cost, when the company borrows more and more, this horizontal axis is financial leverage, debt equity ratio, right? So you can say, well, slowly, the investors or creditors this time, right? Debt holders require a little bit higher rate gradually, right? But when the debt equity ratio passes certain level, then suddenly it starts accelerating, right? The creditors will require very high rate of return for that investment, right? The same thing here, the equity, right? Well, the cost of equity rises to begin with, even without this financial distress cost, right? The cost of equity rises when the debt equity ratio increases, right? Because the equity holders consider riskier, right? When the company takes on more and more debt, right? But after a certain level, it accelerates, right? So, if you think about the weighted average between this line and this line, right? It becomes this, brown line here, or maroon line here, right? Maroon curve, right? It starts here because at that point, we're supposed to have no debt and all equity, right? So the cost of capital will be exactly cost of equity here, right? But as the amount of debt, a proportion of debt rises, it becomes closer and closer to this blue curve, right? But at certain point, the cost starts going back up, right? Because of the distress cost and agency cost. Okay? So up to this point, more debt is better, right? Because that lowers the weighted average cost of capital. But after a certain level of debt, right, that financial distress cost and agency cost kind of takes over the benefit of taking on more debt, right? So the average cost rises back up, right? So we have this kind of U-shaped curve, right, for the average weighted average cost of capital. Okay? All right, so based on that, we can think about the market value of firm, right? If we have weighted average cost of capital this way, U-shape, right? Then we can think about the optimal capital structure, right? What is the concept of optimal capital structure? Cost what? Lowest cost and highest profit. Okay. Yeah. Yeah. So optimal capital structure is the capital structure where the cost of capital is the minimum and the firm value is the maximum, right? Because we're going to use cost of capital to discount the values of equity and debt, right? If you're using lowest discount rate, it's going to maximize the total value, right? So since we have this kind of U-shaped curve now on the cost of capital, we can think about the optimal level of capital structure, right? And at that point, firm value will be the maximum. Okay? That's the story here, right? So, in reality, so according to MM proposition, right? Modigliani-Miller proposition, there is no such thing as optimal capital structure because capital structure has nothing to do with the firm value, according to them, right? But remember, that was under what? Perfect market and under many, many assumptions, right? Including no income tax, right? But when we bring in the income tax to the corporate profit, corporate income, right? Then we find out that, the debt equity ratio matters. The higher the debt equity ratio, the higher or the greater the firm value, right? So if you just think about it, then 100% debt, it will be better. But then in reality, we have this financial distress cost and agency cost, right? So considering all that, now our conclusion is there is such thing as optimal capital structure, okay? And this is how we're going to find out, right? Any questions so far? All right, so here are a few, we just have a couple more slides remaining in this chapter. Some additional considerations here. Yeah. Besides this, the capital structure relationship between the debt equity ratio and the firm value, there are a few other things in reality that we need to consider. Personal tax effects. So far, we've talked about the corporate income tax effect, right? What the corporate income tax does, right? But eventually, the profit will be distributed to the owners, right? And eventually, the creditors will receive their interest payment, right? And here, investors may prefer capital gains over interest income. Right? So if you're interested in investing in any company, right, then the investors may actually prefer buying stocks rather than buying bonds. That's the story, right? If you're going to invest the same amount of money on this company, right, then they usually consider the buying stock is better than bond, right? One reason here is capital gains. I mean, what do you mean by capital gains? What are we talking about? In this situation, in this example, what are we talking about by capital gain? when do you realize capital gain? Huh? What is this? Huh? Hand? This is the first principle you learn when you start investing in stock. Buy low, sell high. Buy low, sell high. Right? A little bit after the bottom, you're supposed to buy. A little bit before the peak, you're supposed to sell. Right? Buy low, sell high. Right? So when you buy low and sell high, you realize capital gain. Right? The difference between the purchase price and selling price, that's the capital gain. Right? Well, that's a profit, and you are supposed to pay taxes on your profit, on your capital gain, right? Interest income is also taxed, right? But capital gain is usually taxed at lower rate than the interest income. Okay? So because of this tax policy, investors usually prefer capital gains over interest income. Okay? So when the companies try to decide whether they're going to issue more stocks or more bond, right? This may be one consideration. Right? Another consideration is industry effect. Okay? Industry effect simply means depending on what kind of industry you are in, right? There is some normal, what they consider normal debt equity ratio for each industry, right? Typically, if you are in financial industry or manufacturing industry, right? The high debt equity ratio is considered normal, higher than average. Okay? If you are in something like software industry, right, then the investors usually expect very low debt equity ratio. Right? Well, the reason is if you are in financial, like banking or insurance company, right, then what you do is you borrow money at low interest rate and lend that money at high interest rate. And you make profit from that interest difference, right? So, when that's your supply. Right? Before you actually lend money to your customers, you have to borrow, right? So that increases the debt of the financial company, right? So normally the financial companies have a lot of debt, right? Without debt, they cannot make money. Right? Right? Manufacturing industry, like automobile manufacturing or the heavy industry. Okay? Well, you need a lot of equipment and facility. You need to invest a lot of money in the facility, right? So that naturally increases the debt. Okay? So here are a few examples. As of November 3rd, 2 days ago, okay, Microsoft debt equity ratio was 50% or 0.5. Right? You can either use 50% or 0.5. Okay? Walmart, which is retail industry, okay? 60.5%. Okay? Duke Energy is energy company producing electricity. Okay? Has 104.47 or 0.5%. 100% debt equity ratio is considered normal overall industry. I mean, across all the industries, right? Investors typically think 100% debt equity ratio is about normal, right? So 50-50%, right? 50% debt, 50% equity, right? Am I confusing you? If debt equity ratio is 100%, then the capital structure is 50-50, right? Okay. GE, General Electric, debt equity ratio is 229.3. And this was a significant improvement from 1 year ago. 1 year ago, their debt equity ratio was 300 something, right? AAL, which is it? American Airlines, is 546.54. Right? Well, they have a lot of equipment, right? The airplanes, okay? And they have issued a lot of bonds, okay, to purchase and lease these airplanes. Okay? Here's an interesting. Samsung Electronic. I don't know whether this is right. 6.5%. Does it make sense? Samsung Electronics' debt equity ratio is 6.5%. Can you believe it? There are many Samsung divisions. There is, I think Samsung USA, I think, something like that. But I believe this is the main Samsung Electronics in Korea, okay, that I could find. Okay. 6.5%. So almost no debt here, right? So that what that means is only 3% of their capital structure. 3% debt, 97% equity. Is it good or bad? Huh? Bad? Why is it bad? They don't have...
They abandoned their
Right. Well, usually low debt equity ratio is considered good because, obviously a company doesn't have much debt and the risk of financial distress is very low, right? But if you have this low debt equity ratio, you can think of a couple of reasons that this is unusual. Okay? First one is that as the debt increases, what also the companies many times take on debt, and as a result, what increases? What? ROE, return on equity, right? Return on equity increases, right? So profitability to their owners, shareholders, right? That's ROE, right? Return on equity, right? So there's a lot of potential increase in profitability that they are sacrificing. Okay? Another thing you can think of is companies usually borrow money to what? Invest and grow, right? When they need to build another plant, another project, right? They usually borrow money, right? And if that is so low, well, perhaps they are making enough money, right, to reinvest, right? They don't have to borrow money. But that was the case with Microsoft until a few years ago, right? Microsoft barely had any debt, right? They were having too much cash. That was the problem, right? Uninvested cash, right? So, I don't know. Why don't you check this, verify this, whether this is correct number. That seems a little too low to me, right? All right, so that's the industry effect, right? So depending on industry you're in, there's what we call normal debt equity ratio, right? And market tends to reward the firms with this capital structure. In other words, what do we mean by market? Who's the market? Market tends to reward the firms. I think we're talking about stock market. Stock market tends to reward. In other words, when a company has the debt equity ratio which is considered normal for their industry, right? Their stock price is positively affected, right? On the other hand, if company has abnormal debt equity ratio, too high or too low, right? Then their stock price tends to be punished, okay? Or suffer in the stock market, right? That's the idea of industry effect. Signaling effect. Due to asymmetric information, any changes in capital structure can send a signal to the market, right? So asymmetric information means, company insiders know everything, but outsiders don't have exact information, right? So company may change their capital structure for valid reason, right? They decided to issue equity, right? New stocks, right? When they need more money, and the reason may be in order to maintain their target capital structure or optimal capital structure, right? They need a little more equity compared to debt, right? But usually, to the outsiders, right? When company sells more shares, that is considered not very good signal. Not a very good signal, right? When they issue new shares, they have to be really careful. Okay? So many times the companies prefer debt offerings, the bond offerings, compared to the equity offering. Okay? After all, equity offering, when you issue more shares, what that means is you're increasing number of owners, right? And that means dividend per share goes down, right? So it's not good for the owners. You can say that, right? Okay, and finally, some other consideration: the pecking order theory about the capital structure, right? Pecking order theory simply says, instead of trying to achieve a target capital structure, firms may simply use a financial slack to take advantage of the investment opportunity. Okay? Financial slack simply means extra cash. Okay? So, according to the theory, this capital structure decision, whether to increase the debt or increase the equity, should follow this optimal capital structure through the very careful analysis. You should decide whether to increase debt or equity, right? But in reality, right, what happens is whenever there is extra cash, right, the companies may repurchase their equity, right, or another thing we can add there is the retained earning is preferred. Right? So instead of issuing new debt, new bond, okay, they may use the extra cash or retained earning. They may retain their profit, right? instead of issuing more debt, right? So that's what the pecking order theory. Pecking order. You know what pecking order is? Pecking by bird, right? And when you have this kind of bird family, okay, there is a seniority. When there is let's say, something to eat, right? Maybe some worms or something, right? The bird with the highest seniority pecks first, and so on, right? That's what we mean by pecking order, right? Here in this case, company has some preference over some the sources of cash, sources of capital, right? So instead of raising debt by issuing more bond, they prefer to use retained earning, right? The profit they have generated, right? That's what I mean by pecking order theory, right? So, in that case, I mean, the optimal capital structure may not be achieved. According to the optimal capital structure, you're supposed to issue more bond. But because companies have preference of using retained earning over issuing more bond, right? They may not issue more bond and just use the retained earning, right? Also, related to our previous discussion of signaling effect, right? Even when they think the issuing more equity is desirable, they may be afraid of sending wrong signal to the market, right? To the outsiders. When you issue more equity, you may send a signal that the company is in trouble or something, right? So they may be reluctant to issue more equity. Market timing is similar idea, right? Instead of deciding the issuance of bond and equity based on the optimal capital structure, they may simply issue new stocks when the stocks are overvalued, right? So depending on the market situation, maybe economy is strong or something, the stock price goes up, right? Their stock price goes up, right? Then company decides, well, this is a good time to sell more shares because you can sell them at high price. Okay? And in essence, what the company does in that situation is they are benefiting existing owners at the expense of new owners. Let me repeat again. Selling the new shares when the shares are overpriced. Okay? Overpriced means, for some reason, because of the demand and supply, right? The share price went up in the market, right? There is no really, intrinsic value increase in the company, right? So when you sell more shares at high price, the new owners are paying extremely, unreasonably high price, right? But, the company can raise capital at this high price, right? And of course, use that money to increase the profit, right? So existing shareholders benefit, but the new shareholders are paying very high price, right? That's the idea, right? So, many times they observe this kind of behavior in the market. When the stock price goes up, the companies issue new shares. Well, of course, right? So that's kind of a timing behavior, market timing. Finally, financial flexibility. Right? Actual debt ratios are much lower than optimal level because the managements are risk averse. Right? Managers are risk averse. They don't want to get into any trouble, right? If you follow the theory and bring the debt ratio up to the optimal level, you may be able to increase the company's profit and shareholders' wealth, right? The thing is, information is asymmetric. Again, what does that mean? Asymmetric, information asymmetric. Managers know everything. Managers have all the information, all the numbers. They crunch the numbers every day, and they know what the optimal level is, right? Shareholders have no idea, right? They have no information, no idea what the actual the situation and workings of the business, right? So what do shareholders see? How do they know whether the company is doing good or bad? Stock price, okay. Huh? Dividend payments, yeah. Stock price and dividend payments are affected by what? Huh? Revenue, rather than revenue, but the profit, right? Earnings per share, right? Every 3 months, every period, every quarter, the companies announce earnings per share, right? And when the earnings per share is announced, there is a huge fluctuation in the stock price, right? If they meet the target or meet the expectation, right? There are people who are called the analysts, market analysts, right? And they constantly predict the earnings per share for each company, right? And when the actual earnings per share comes equal to or higher than their prediction, right? Then they say the company has met the expectation, right? If actual earnings per share comes below the expectation, then they say the company has missed the target or missed the expectation, right? If they miss the expectation, the stock price drops, right? Quickly, right? So the owners, shareholders look at that information, earnings per share announcement, right? When I was working for Family Dollar Corporation, right? Every 3 months, the announcement day, earnings day comes, right? And when the Family Dollar announces the earnings per share, first thing they look at is Dollar General's earnings per share, right? Their competitor, head competitor, right? And as long as your company beats your rival's earnings per share, everybody goes, phew, we're safe, right? Because stockholders, all they see is just a comparison, right? I mean, these two companies are same industry, right? Same business, right? And if your company does slightly better than your competitor, then there is no reason to complain, right? You have no ground, no other information to complain. Whether the managers are doing their best or not, stockholders don't know, right? That's the source of actually agency problem, right? In that case, the principals are stockholders and agents are managers, right? And stockholders have no idea what's going on in the situation room in the company, right? The operational decision. Okay? Okay, so that's the financial flexibility, the same idea. Okay? Even when the analysis shows your debt ratio is supposed to be 65%, right? Managers may actually choose only 50% because they want to have this safe cushion, right, or flexibility, right? All right, that's chapter 13. I see there are only 8 problems in this chapter, so why don't you try all those problems, okay? And we're going to go over them sometime in the future. Any question?